Welcome to the London Property Podcast, your go-to source for navigating the complex and ever-changing London real estate market. Our digital marketplace provides informative and educational content from industry leaders through podcasts and videos. We cover various aspects of the real estate experience, including buying and selling, finance, law, tax, construction, design, and more. Join us as we delve into the latest trends and developments in the market and gain valuable insights from our panel of experts.
Hello and welcome to London Property. I'm your host Farnaz Fazaipour, and today we're doing our market update videos, and we'd like to welcome Marcus Dixon of JLL, Head of UK Residential Research, back to the show. Welcome back.
Thanks for having me back.
And we also have Tom Bill, who is running UK Residential Research at Knight Frank. Welcome back to the show.
Thank you.
I'm going to start with you, Tom. So let's tell us about what's happening in the market at the moment.
Gosh, what's happening? There's a fair amount going on, I would say. Lots of competing forces. I mean, broadly speaking, the global picture is pretty fluid at the moment, as we've seen from the various mixed messages coming from the White House in recent weeks, trying to sort of guess what economic policy is going to look like coming out of the US, trying to guess what the economic policy is going to be in the UK is a little bit tricky. And I think against that background, there's a fair amount of uncertainty around at the moment, which I think has probably skewed the property market to a degree. So I think, in a sense, the uncertainty up to a point is actually quite a good thing for the market, because that has kept downwards pressure on mortgage rates. So there are concerns around what the UK economy does next. Then the Bank of England will be expected to lower rates more quickly. And that has actually stimulated a bit of demand sort of in lower value markets, I would say, or needs-driven markets. And then beyond that, I think in more prime markets, I think there's just a general air of confusion. So those markets are more susceptible to what happens on Downing Street or in the White House. And I think at the moment, there's a certain amount of confusion around what the respective governments on either side of the Atlantic are saying. They're sort of, Trump's been in power for 3 months, the Labour Party have been in power for 7 or 8 months. So they're both relatively new. So we're finding out where we're going to go next, and the property market is coping as best as it can.
So now you get the hard job of going second, Marcus.
Yeah, well, I think probably all of that, plus probably a couple of other things I'd mention that makes the property tea leaves even more difficult to read at the moment is the changes that we saw to stamp duty that came in on the 1st of April, which meant that the lower end of the market was quite a bit busier in the last few months than maybe it would have been normally. Stamp duty, even if it's a relatively modest saving for someone, does seem to pull forward quite a lot of transactions. So February and March particularly busy in terms of transactions. I think March was something like 90% up on where we were a year ago in terms of the number of properties transacting, which means that we will probably see a slowdown in activity over the next few months, which isn't necessarily a reflection of a slowing market. It's just that those deals that normally would have happened sort of April and May will have been pulled forward earlier into the year. So sort of reading into that, what that means for the market, certainly in the short term, is going to be more difficult. That obviously has a less of an impact on the prime central London market. But actually, if we look at transactions below £2 million in prime central London in Q1, they were, I think, probably about 20% higher than we saw last year. Last year wasn't a particularly vintage year in terms of activity, but we did see an uptick in that market. So there will be a little bit of an impact around stamp duty in that market too. I guess just linking into some of the things Tom was saying as well about the uncertainty, particularly the uncertainty around tariffs in the US, that will continue to develop as we move through the year. We are looking at potentially some positives from the market from that, or at least sort of less negative maybe than we were seeing before. Certainly in terms of the rate, the predictions in terms of the rate of fall in the bank rate, we're expecting, I think, up to 4 25 basis point drops now this year, which was 2 a few months back. So we could see debt costs reducing. Also uncertainty that the US potentially driving more US buyers and US tenants into the prime central London market. I think it's probably a little bit early to tell if that's just a bit of a blip or it's something that we see continue throughout the year, but potentially a little bit more activity coming through there.
So, Marcus, we're talking about the effects of the stamp duty on the lower end of the market, and Tom was talking about the needs-based demand. So, would it be fair to say that what's hit the market the hardest is actually international interest, or do you think it's both international and domestic?
I think domestic market has definitely been stronger, I think, more recently, certainly in terms of activity, but we've actually seen relatively robust levels of activity from overseas buyers. The new homes market has been a bit more challenging. I think those investors who traditionally buy new homes in central London are cross-shopping more locations than probably they used to. So London, whereas it would have been the default choice for a lot of investors, is now having to compete with other locations, more established ones like New York and Sydney, but also if we think about some of those emerging investor locations like Dubai that have become particularly popular recently. So I think there's definitely been a bit of a drop-off from certain groups of buyers. If we look at our sort of new home sales book, it's definitely still dominated by overseas buyers, but the proportion of domestic buyers has certainly increased. If we look at, I think so far this year, we're at just shy of 60% of our buyers for new homes come from overseas, which would have been sort of 75, 80%, probably sort of 7 to 8 years ago. In terms of who's buying, still dominated by Asia, so China and Hong Kong still pretty strong, but we are seeing an increase in Middle East and also, interestingly, American buyers in the new homes market. Traditionally, they've been tending to buy more in the sort of established prime central London period housing stock, but we are seeing a bit of an increase again in those American buyers coming into new homes. So I think a bit challenging for the UK, particularly if we're thinking about changes to sort of non-dom regime and some of the messaging that sends. But we are still seeing buyers coming in and purchasing homes in London, certainly at the start of 2025.
So, Tom, on the subject of new builds, there's this message where the government's saying we need to build 1 million homes, 1.5 million homes, and then you've got all these new homes that have been built, but they're actually sitting there and they're not attracting locals, and they've been built to target overseas. So what would be the sort of balance in that situation? What would be a good result, that we've got all this empty stock that people are not buying, but actually they haven't been designed for purpose for what the government is saying that they need? Yeah,
I mean, what the government's been saying around how many houses it's going to deliver has been one of the slightly more challenging targets. I think it's probably set itself. There's no way it's going to get near 1.5 million homes, and I think it's just fundamentally misunderstood how the housing market works. It's not a case of build it and they will come. It's a case of you build it if there's demand for it, and house builders are not charities. They're often PLCs who build because they want to make a profit for their shareholders. That's just the way that it works. That's the system that we have. And within that system, they're going to deliver homes set at the market value. And so it's going to be about, can people afford to buy those homes? That's going to be looking at things like the mortgage market. So is that downwards pressure on mortgage rates going to continue? And that will determine take up and all those sorts of things. So I think it's sort of that's the way that it should be seen. It often isn't, because it's become a political football, and I think it's become just misunderstood.
And on the subject of that, Marcus, that the property is used often by politicians, and in this particular scenario that we're in at the moment, what would you say are the main kind of issues that they've completely misjudged, and the impact that has had on our market that we're seeing today?
I think for me, there's probably two that are worth talking about. Well, there's a lot more than two, but I'll start with two. Yeah. I think the first is linked with Tom's point around new homes, and I think it's just not recognising that we need demand side incentives as well as changes to the planning system and all these things, which are good in terms of increasing delivery. But if we want house builders to build more homes, we need to demonstrate that there are buyers there who will purchase them at a price that allows those developers to make a profit. And it seems slightly strange to me that we've got to a point in the market where we're talking about this really ambitious housing target, and yet we have no real incentives in place, particularly around first-time buyers. We're disincentivizing buy-to-let investors. I mean, we have been for quite some time when we've got a real crisis in terms of the rental market and rental supply. And so I think that challenge around demand-side incentives is something that I was certainly hoping we'd be hearing a bit more about from government over the course of the last few months. I'd hope that we hear a little bit more about it, maybe at the spending review or in the autumn at the budget. I think the challenge is that we lose a lot of momentum in the market if we don't know that that's going to be there. It takes quite a long time to turn the supply tap back on once it's been turned off, and I think that's the real challenge at the moment. I mean, I think some Molior data came out a couple of weeks ago that said that 23 out of the 33 London boroughs had no housing starts, private housing starts in Q1. And this is at a time when we're supposed to be increasing housing delivery. So there's real challenges there in that market. And I think my second point probably linked to that is around investor demand and the rental market. We are seeing a number of changes being put into place that potentially reduce the amount of rental stock that we're seeing in the market. We've got the potential for EPCC by 2030. We've got increasing amount of taxation on private landlords. They're obviously looking at institutional landlords to bridge that gap. But if we look at the size of the build-to-rent market, it is less than 2% of the overall private rented market. So whilst it is an important factor, the drop-off in the number of particularly new landlords that we're seeing coming to the market is going to be a real challenge in terms of rental supply going forward.
Before I ask you a question on rentals, is there anything you wanted to add to
rentals? Yeah, I think in terms of what's happening with the Renters' Rights Bill, again, I think that's probably another example of where the government may have to learn the laws of unintended consequences around some of its policies. What we've seen so far, pretty clear evidence of, is that landlords are not generally, or a lot of them are, but some landlords are not sticking around. So supply is a challenge, which means that's pushing up rents, which means that the legislation is doing exactly the opposite of what government set out to do, i.e. protect tenants. And I think that it's a bit of a mess that I think is waiting to happen. If things start to go through the courts and down through legal channels, then I think it could get sort of a little bit messy for landlords and tenants. Which, again, I don't think that was what the government planned to do, but I think that's how it could go. And all the messages that are being sent to landlords, with all the sort of the green regulations that are coming down the line, the fact that mortgage rates are higher, the fact even the tax changes announced at the budget, landlords are just looking and thinking about, does this stack up? And more of them are thinking that it doesn't. Those that are staying are enjoying, better yields potentially and higher rents, but at the moment it's not really heading in the right direction, I'd say.
And with all the changes that have, very noticeably, Marcus, I'm going to ask you this question. With all the changes that have noticeably made a lot of wealthy people exit London, are you seeing investment from overseas coming for opportunities that are emerging? So, whether that's built to rent or single family housing, or, is there an area that you'd say it's very hot for overseas investors at the moment?
I think if we're talking about sort of larger scale institutional investment, single family is particularly popular. Again, not so much of a London phenomenon in terms of that activity, but we're seeing an increasing amount, particularly in the southeast. A lot of it was in the Midlands and north of England when it's first started in the UK. We're seeing more activity in the southeast in terms of buying up mainly sort of houses and lower rise flats in those locations. We have seen an increase in multifamily over the last sort of 6 months or so. Multifamily was so your sort of your blocks of build-to-rent flats in city centres was relatively slow in sort of the first half of 2024. It was quite a bit busier in Q4 and also in Q1. So we saw more multifamily investment than single family, which has been a bit of a change from what we've seen more recently. Quite a lot of that is the trading of existing stock, though, and one of the challenges that we're seeing, particularly in that market, is around building safety and a lot of the new gateway challenges that we're seeing coming through. A lot of schemes are held up at the moment, so schemes over over sort of 7 stories are held up with these gateway processes. So I think about 75% of gateway 2 applications that we're seeing put through are being refused and turned back, and people are having to start again in terms of getting those through. So in terms of new supply within that market, it's pretty challenging. But in terms of appetite, we're definitely seeing an increase in demand, particularly from the US, in terms of investing into the UK. The UK is sort of one of the most mature markets for living stocks. So we're seeing a lot more appetite for investment in the UK. I think the challenge is around finding the right kind of stock. There's very little in terms of starts at the moment across London. So I think the data shows that I think housing starts in the first quarter of this year about 60% down on the 10-year average. So in terms of what people are able to buy is increasingly challenging. A lot of people, that these investors are looking for scale. So they're wanting hundreds of units within a development, which again, for more central boroughs is a bit of a challenge in terms of being able to deliver those kind of schemes.
So Tom, would you say that because of all these things, that demand is actually starting to spread out outside of London, and people are actually making lifestyle changes to say, okay, well, it's fine, then I'll go to the suburbs and I'll live there, and those prices are starting to see an increase?
We're certainly seeing strong price growth in outer areas of London than we are at the moment in central London. So yes, that's obviously people that are moving or would have typically moved for family reasons, their families grow and looking for more space. But I think people are there's still probably a bit of working out going on about their work-life balance, even after the pandemic, even all these years later. So that's certainly something that's happening. I think overseas investors are also probably looking a bit further beyond where they did traditionally as well. So at the moment, those sorts of markets, so sort of southwest London, North London, they're doing pretty good, pretty well at the moment, I would say. Talk to our agents out there; they get stock, it comes on their books, and it's sold pretty quickly if it's well priced. So overall, yes, I think probably demand is stronger, certainly, the further you go from the very centre of London at the moment.
Yeah, and Marcus, back to you. So the challenging price range for prime central London, I think potentially we all agree is between 5 to 10 million pounds. So below that, you're seeing more activity, and potentially above that, the gains that people could have for buying things at that level cheaper is also higher. So would you say that is a direct result of all the non-dom exodus, that 5 to 10 million's been hit? And, where do we go from here?
Yeah, I mean, I think that it's probably more about the potential non-dom inflow maybe than necessarily it is about exodus. So you do see there are obviously people who have left. Quite a few of them have held on to their properties within the UK. We have seen an uptick in terms of listings, but not necessarily as significant. We normally would see an uptick in listings as we move towards the spring. And so it's not necessarily as significant as maybe we would have expected. But I think there's sort of a bit of a double whammy in that price bracket, in that actually quite a lot of people there will be buying with debt, and obviously mortgage costs have been pretty significant. The cost to upgrade from a £3 or £4 million house to a £5 or £6 million house is higher now than it has been for some time. So we're seeing a lot of people just staying put, and so I think that market will, continue to remain challenging until we start to see rates drop back a little bit further. The sort of sub 2 million market, as I said, a bit busier. It kind of reacts more like the mainstream market, maybe, than that sort of 2 to 10 million pound market. But I think still pretty challenging in terms of that price point, in terms of encouraging upsizing and people moving within central London. But having said that, if we look at overall activity, the number of sales has remained sort of surprisingly strong, I think, considering a lot of the challenges that we've had for the market over the last sort of 18 months or so. So, whilst activity within that market has dropped back, it's maybe not dropped back quite as much as we'd expected.
And Tom, are there any areas in London that you're really seeing an increase in activity and a healthier growth?
The areas that I mentioned, I would say, those outer areas. But just to pick up on the point of sort of overseas, how are overseas investors feeling at the moment? I think that sort of 5 to 10 market is suffering because of what the government's doing around non-DOMs, not just among non-DOMs who are not the be-all and end-all of that market, but they're certainly an important component. But the message I think that's getting sent, and it's an interesting sort of conundrum, because on the one hand the message is being sent around sort of, how welcome they are or how welcome they aren't. But at the same time, the UK on that global stage is actually almost by default, rather than design, looking relatively attractive when you look around and look at the US and you look at parts of Europe and other parts of the world. I think it is gaining a degree of interest from overseas investors, but not to the point where it's going to sort of the hole's going to be plugged. But if the government were to play its cards right, for example, and it were to introduce something that was sort of fairly neutral sounding, like a UK investor visa that it could sell to its own party, then I think you would see the government's headroom grow, which I think is what they're very concerned about. I don't think any of this was done by design. I think the government is genuinely concerned about the narrow bandwidth in which it's operating. And at the moment, it's pursuing policies that are not doing anything to allow that to grow. When the government sat down with non-DOMs and the sort of the various lobby groups, they were told in no uncertain terms we would happily pay more tax to stay here. And we're not about tax avoidance or evasion. We would happily pay more tax because we want to live in the UK. And I don't think that message landed. I can't quite understand. You've got one side saying we're happy to pay more tax. You've got the other side saying we need more tax. The fact that you couldn't make those two things meet in the middle, I find disappointing.
It's very disappointing that actually so many decisions are made about property without speaking to property people. I think that's primarily the problem here. Is, you need to actually speak to people who are doing this day in, day out, advising investors, so that you can actually make informed decisions about what the consequences of certain changes are going to be.
Yeah, but those non-DOM changes, they would be very, very small tweaks, would have had quite a big impact. So we were talking earlier about the inheritance tax and the fact that people are wary about being their worldwide assets are going to be exposed to UK inheritance tax. And I think that was a big stumbling block that, again, presumably wasn't a particularly difficult thing to change in terms of the wider legislation. It would have been a relatively small tweak to make and a relatively innocuous tweak to make, I would have thought as well. But they didn't make it, and we're seeing the result now.
It could have just said, if you were born here, you have different rules than if you weren't born here. Would have already been better. Yeah,
I think that the inheritance tax challenge is something that they should have realised a lot earlier, because if you look at, even for people who were remained in the UK, will never even touch anything like a non-DOM regime within the country. The majority of people in the UK expect that they will sit outside of the inheritance tax free allowance, when the vast majority won't. And the fact that most people think that they will fall within it, which means that most people are against inheritance tax in some form, I think probably should have been used as a bit of messaging around that this was going to be really challenging for prime central London in terms of what that's going to mean for people's planning. And actually, when you talk to non-DOMs who are considering leaving or have left, it is that inheritance tax angle which comes up again and again in terms of the reasoning behind that. Whether there is, it's something where they'll go off somewhere else, their accountants will come together and work out a way of getting around this. I think that could be, or indeed will wait for a change in terms of policy. But obviously that doesn't help the market in the short term.
Yes, well, the market's been flat for about 10 years, I think we can all agree. So, are we seeing another 10 years of flat market is the question.
Well, I think that if we see another 10 years of flat growth, prime central London looks increasingly affordable in terms of, affordable is a sort of slightly strange way of talking about it, but if we look at prime central London in relation to other markets and also in relation to the wider UK market, I think we will start to see more investment coming in. So, we are confident that we'll see growth. So our forecast is for around 20% growth in prices over the next 5 years. I would say that forecast is probably a little bit more uncertain now than it maybe was when we made it back towards the back end of last year, in terms of of what we're potentially going to see in terms of the repercussions of a lot of the changes that are coming through at the moment. But I think there are some signs that we could see more activity in the market, particularly if we see investors coming in from other areas of the world where we maybe see some either economic or political challenges, particularly if we're looking at the US. But there's a lot of uncertainty now around quite a number of global economies, and the UK as sort of a slightly accidental safe haven, I think, is a real prospect going forward. One of the other angles that we've been looking at is around overseas students. Overseas students are particularly important for the UK, and we continue to see investment from them and their families in terms of buying properties for them when they come to the UK. A lot of overseas students currently go to the US, so the US is the biggest market for overseas students, particularly from countries like China. Some of those challenges around tariffs potentially have repercussions as to where those wealthy individuals send their children to be educated, and we think the UK could be a real beneficiary of that.
And there's been some changes in talking about their visas, I think, in America, and some things to do with students. What about you? What would be your prediction now for 10 years flat? Are we having another 10 years flat?
I don't think we will see 10 years flat. I think what's happened over in recent years, we've kept pushing out when we think things are going to start to actually finally tick up a little bit. What we're probably going through at the moment is a bit of we're sort of seeing firsthand what the market's been almost concerned about previously, about the sort of a government that comes in and starts changing policies and laws and making the sort of tax landscape much more unattractive. That's happened. So I think we'll come to a point where we're no longer worried about this spectre that's hanging over the market, and we'll just sort of know where we are. Because we're sort of at the stage now where we're finding out actually how is any of this stuff going to work? And through the other side of that, whether that's a new government or whether that's a sort of change in direction from around tax policy, I think that's when you can start to see things pick up. I don't know how long that process is going to take, but I think we're sort of discovering now, what happens when you do when you do kind of axe the non-dom regime. That there's been sort of people have been worried about it for a long time, but prime central London, back compared to its peak in sort of 14, 15, is looking pretty good value, and especially when you've got dollar pegged or dollar denominated buyers. That's a big discount that that PCL is offering. So I think we would see that prices probably will rise over the next 5 years.
What's Knight Frank predicting? So we've got 20% from JLL. We're taking bets.
It's just not far off that. I would say slightly below that, sort of 18% or so. I would say. I think just sort of looking at the numbers right now. So yeah, that's fairly modest growth, annual growth over the period, sort of 3-4%. I think in the short term, I think we'll probably see things pretty flat in 25, and then before picking up slowly. But I think it could pick up a bit more quickly. It's not going to go back to 20% annual growth where we were after the global financial crisis. But I think things, once they do pick up, whatever the catalyst might be, I think it will happen quite quickly because all the conditions are sort of ripe.
Good. Well, let's hope that things do become a bit more interesting, or that people go to all these other countries and realise, well, actually, the UK kind of sits in the middle of all these other offerings, and I'd much rather be there, and then they come back. So that's the silver lining. So thank you both for your time. It's always a delight to hear facts and figures from you both. So thanks for coming again.
Pleasure. Thanks for having us.
Thanks for tuning in to our latest episode of the London Property Podcast. Head over to our website where you can browse our exclusive network of top experts driving the market. As a member, you'll have direct access to our experts and their networks. Our award-winning content will help you choose the right professionals for your needs and make informed decisions about your investments. Personal recommendations are a powerful tool in connecting with trusted professionals. Let us introduce you to the right people to help you achieve your real estate goals. Contact us now to learn more about becoming a member and gaining access to these valuable resources, or joining our directory of experts.